Good afternoon, tech traders. Today is the 12th of March. It is about 12 o'clock in the afternoon on this Sunday afternoon. And I thought I'd do a quick update on exactly what a run on the bank looks like. If you've been at all paying attention to the news, you would have seen the collapse of Silicon Valley Bank, which happened at breakneck speed. It happened at the end of last week. Literally, the state came in, boarded up the place, shut them down, stopped trading. They're done. They're out. They're gone. And that was a classic run on the bank. You can see it on the chart in front of me that the price just started plummeting here, and they had to put a stop to it because they just didn't have the liquidity to meet the demand requests for withdrawals that they were getting. And so they put the Silicon Valley Bank is now in receivership with the Federal Deposit Insurance Companies, the FDIC. And this is very big, folks. This is very big. I am not one to like to spread too much fear, but this one is something you should keep an eye on because the dominoes on something like this can fall very quickly. You don't need to be in horrible financial trouble to have a run on the bank. If people think you're in financial trouble, trust me, you're in financial trouble because they're going to look to pull their deposits from you. So this one, Silicon Valley Bank, is done. They're out. And there's a lot of people that, however, rely on these people. I'm thinking about companies like Roku or other startups that have all of their assets with this bank. You know, these people still have to make payroll at the end of the week. And, with all this money, whatever deposits are left over, which there are pretty much none, people are going to be fighting to try to get whatever they can out of this bank. It won't be a fraction of what they probably had there at one point, and so there could be a significant amount of pain here. There's need, or there's a request out there from the activist investors, the people like Mark Cuban and all of his contemporaries that are looking very simply to have the government shore up the regional bank sector here, government shore up these banks. The problem with that, unlike 2008, is this is an event, or this is exactly what the government was looking to do, was to take the excess liquidity out of the marketplace. I don't see them stepping in here and shoring up the industry. Now, I could be wrong. I'm not an economist by any stretch. And you know, here at Trading Edge Capital, we do not predict, we only prepare. So God knows what's going to happen with this sector, but some of the regional banks are very much in trouble right now, and they're going to need a shore up of liquidity, assuming that we can calm everybody down here a little bit and stop looking for their money. I keep thinking back to that George Bailey It's a Wonderful Life movie where Tom comes in and he wants his money out. And George says to him, Tom, it's not like I have your money in the bank vault here. Your money is in Jim's house over here and in Peter's house over there. And Tom didn't want anything to do with it. He wanted his money out. And, fortunately, George Bailey had a little bit of liquidity, if you recall in the movie, something that Silicon Valley Bank did not have and they could not raise. So as tech traders, what do? Remember, we do not predict. We prepare, and we're aware of what's happening in the marketplace. Fear in the marketplace, you're going to see it here, this spike in implied volatility before these guys went under, is that very fear. If I look at just opening up Davos, when I opened it up yesterday morning, the first thing I noticed was something that you don't see very often, which is a complete reversal of the VIX term structure. So I didn't put anything into Davos. And the first thing I noticed is, oh my God, the VIX term structure has gone from contango into backwardation, which basically means that the near-term volatility is selling at a premium to the far-term volatility, meaning fear is right here, right now. So now, granted, we have some data coming out this week. We've got there's a lot of fear in the next 9 days in terms of what is the CPI data going to look like. what is going to happen with this banking sector. So there's a lot. You see this spike in the 9-day VIX. However, the thing that's got me concerned is the entire curve is in backwardation. The 6-month VIX is elevated to the 1-year VIX, and this is something that should be interesting to you all. So with that, we got to look for opportunities out here, and what are we going to find? In the financial sector, I think there's lots of opportunity. I actually do own Bank of America. It's one of my holdings in my portfolio. Here's that fear spike right here. This was driven by Silicon Valley Bank right here, and you see this precipitous price drop here. Now, I've got a buy zone here of where I own the shares way down here at 25. So I'm quite comfortable that my assets are, I've got ownership in Bank of America at a very good price. Trust me, folks, if this gets down to that price again, I will be backing up the truck for Bank of America at that price. I think I've got it at a very, very good price. I'm also trading around it. You can see I have some active trades in a short put and a short call out here. And oddly enough, the way I positioned these things is even after the drop that we suffered last week, I'm sort of in the midpoint between that strangle between the short call and the short put. Now, these because the vol spike here, these things are not going to be valued super high right now. I don't plan on taking these off. But what I may do here is I may layer positions on top of this. So depending on what happens this week, I may be looking to layer in positions with the volatility elevated this high. That's a great premium selling opportunity. The other thing I noticed on Devos is a bunch of these things have turned over here with the market data. A bunch of them have turned negative. I mentioned already the backwardation of the VIX term structure. The skew has now gone negative, which means that the out-of-the-money calls are selling at premiums. The out-of-the-money options are selling at significant premiums. So it's another way of saying if you're looking to buy a hedge out of the money, it's getting very expensive. So another indication that there's fear in the market is this skew now going up over 125. The other two, which are still showing green, is the VIX at 24.8. You'll look at VIX and you can see what's happened to VIX in the last couple of days. And here you'll be able to see the spike right here. So I'll blow that up a little bit. This is the spike in the VIX right here. It's been a very, very loud day here with the VIX. And the other thing you'll see is that the VVIX, which is currently shot up to about 108. Both of these turn red very soon. VIX above 25 is going to turn that indicator red, and VVIX above 110 is going to turn that red. So I would not be the least bit surprised if all of our market indicators are turning red at the beginning of this week. So fear is all around us right now. So back to Bank of America for a second. I would likely be backing up the truck for this at my buy zone around 25. Maybe I'll start a short put campaign to get there, layer in some risk on positions that I already have. But that would be a very good buying opportunity on Bank of America. Other ones probably exist in things like Citibank. You can see Citibank has got that same fear spike, just turned yellow here. We've got earnings coming up on Citibank. Looks like there's a buy zone, at least maybe some form of institutional buy zone around $40 a share. Probably not a bad place to own Citibank if that were something that would interest you. Wells Fargo, another one that is probably seeing a big volatility spike. Yep, there it is right there, and a big drop in price. And Garch models have that predicting all the way down around $35 a share, which I believe historically is actually a low point. No, actually the low point of the last 5 years. This was the crisis that Wells Fargo ran into. They've traded as low as $20 a share. They have a Trefis price of around 52. So that's a good value. That's a good business to be owning at that sort of price. Certainly around $20 a share. I'd probably get interested somewhere closer to $35, $40 a share which is not, that's within the first standard deviation when you get spikes like this in the volatility. So anyways, there is lots of fear and about. I don't have a trade necessarily for you today. I just wanted you to be aware of what's happening out there. Pay attention, folks. This could be a big thing. I hope it's not. I don't like to see people lose their jobs, and it's a sad business we're in when that has to happen. But this could be a big deal. And I think it's something worth taking advantage of when the opportunity presents itself to buy good companies at good prices and trade around them the way we do. So that's it for today. I hope you found this useful. We will certainly be in touch with how this thing develops and any opportunities that it might present. For that, enjoy the rest of the weekend. We will be in touch shortly.